Hi, I'm Grant Stephen.
And I'm Chris Bernier.
And we're the two investment guys. This week, Chris and I want to talk a little bit more about the markets. If we consider where we're at with global indice returns so far this year, in the last couple of weeks, we've had a bit of a sell-off, somewhere between 3 to 5%, depending on what market you're in. Actually, April is tracking for the worst month since September of 2011. Now we're only about halfway through the month, so I don't know. That's not terribly meaningful at the moment, but just as a point of interest. We still have a lot of positive momentum in the market. If you consider the NASDAQ, despite that sell-off, still up 16% so far this year, and Germany as well. In Europe, Chris, still up 15% despite a bit of a pullback. We wanted to talk a little bit about probably the two most important economies in the globe as it relates to global GDP growth. And of course, that's China and the US. Chris, why don't we start with China?
Sure. Well, if we look at China, recently the Chinese government came out with a growth forecast of roughly 7.5%, which would be enviable by most economies around the world. But for China, given their recent performance in the last number of years, 7.5% is quite a fair slowdown. Now, recently in the first quarter of 2012, their GDP came in at 8.1 versus 8.4, so still a pretty good number, but has tracked downwards for the last number of periods. We are seeing purchasing managers index data improving. That's more of a forward-looking indicator. And we are seeing a trend recently in loans rising in China as well. So that is another forward-looking indicator, because that money is going to get put to work in the economy and presumably produce some additional growth going forward.
Right. I think the weak link in the China data right now, Chris, is the export data to the EU,
right?
Which is pretty slow there. Now, let's turn to the US, because there's some pretty interesting data trending there. We just had the retail sales numbers for March, and they were up over February 0.08%, which doesn't sound like much, but I'll qualify that in a minute. The year-over-year number is more impressive, where it's 6.5% versus a very long-term average back to 1993 of 4.7%. Now, in context, remember, the U.S. economy is driven, 70% of that GDP production is the consumer. And so what we've got here are some numbers that are improving significantly, and you cannot ignore that trend. And where it's going to likely lead to is a revision higher in U.S. GDP growth, up from 2.5%. So, we're not on the bandwagon that says you've got to pile on and get into the U.S. Because there's a lot going on there. All we're saying is you can't ignore these really important trends that exist in the largest economies in the world, and I think that's important.
Yeah, and another important factor with those numbers is it was very broadly based. It wasn't focused in one individual sector. And as Grant pointed out, the U.S. economy is really driven by the consumer. That's what China is trying to do, get away from that export growth and look at more domestic consumption to help grow their economy. And that's the transition that they're going through right now.
Yeah.
Now, if we look at some of the concerns going forward, there's still a possibility, and a number of analysts are talking about quantitative easing 3, as I guess they're calling it.
Right, and that's just throwing a lot more liquidity in terms of dollars through monetary policy back into the market. Some would argue that it's already a little too flush, and that's part of the problem. Maybe rates start to rise at some point in any meaningful fashion. Now, we're not talking a spike in rates, but we are talking, these extremely low rates can't be sustained forever, or at least that's unlikely. And the latest, if you're not tired of the EU debt crisis, the latest culprit that's getting picked on is Spain. A lot of Spanish debt there. Now that's not news, Chris, but what is interesting is a lot of that sovereign debt is held inside their banking system, which is similar to the debt crisis that occurred in Ireland a couple of years ago, or a year and a half ago. And I just think that that's kind of got us taking note what's happening there. So therefore, we're watching these Spanish auctions, the debt auctions, and what's happening with the interest rates there, because that's going to tell us a little bit about where that story may play out.
That's right. Now we're just early on in first quarter earnings for 2012. So far, things are looking pretty good, and we'll bring you up to date on that in the future. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. As Kris said, we're going to pick up the slack a little bit and talk more in depth about the current earnings. So until then, I'm Grant.
And I'm Kris.
And we're the Two Investment Guys.